All right, so you guys want to hear more about this whole and the Fed thing, and I gotta say, Ron Paul's book is a wild ride.
Yeah, it really takes you places.
We're talking history, economics, and some really interesting stories from Paul's own life that make those ideas, really hit home.
It's true. He's got a knack for connecting these everyday moments to these huge economic theories. It's really engaging.
Totally. Like, who would have thought that a story about milk could be the key to understanding, like, monetary policy?
Right.
But he talks about his dad's dairy business and how it taught him about the dangers of diluting value, not just milk, but currency, too.
It's such a good analogy. You can almost picture young Ron Paul watching someone water down the milk and realizing that's basically what inflation is.
Yeah.
Your money buys less because its value's been well diluted.
And that idea, man, it sticks with him. It comes up again and again throughout the book. He also talks about seeing rationing and black markets firsthand during World War II.
Which really solidified his belief in free markets. For him, it proved that markets will always find a way, even when the government tries to, control things. He saw people adapting trading outside the official system, even if it meant breaking the rules.
Then there's his grandmother's experience with hyperinflation in Germany in the 1920s. She was so afraid of money going bad, and that fear really left a mark on him.
It did. It's where we start to see those seeds of distrust in government control over money. I mean, hyperinflation can wipe out savings, destroy businesses. It can really tear a society apart. It's no wonder that experience stayed with him and shaped his views.
It makes his focus on sound money so much clearer. It's not just some abstract theory. It's tied to these real, tangible experiences. The consequences of getting it wrong are, devastating.
Exactly. And for Paul, 1971 was a turning point, the year Nixon took the U.S. dollar off the gold standard. He describes it as a betrayal of sound money principles, and it really pushed him to become more politically active.
So we've got these formative experiences shaping his thinking. But then he also goes deep into economic theory. This is where the Austrian school comes in, right? Economists like Mises Hayek.
And Murray Rothbard. He was a big influence on Paul's thinking. The Austrian school emphasizes free markets, limited government, and sound money. They're very critical of central banking, which of course is at the heart of Paul's argument in the Fed.
So how did these ideas really click for him? It seems like reading Rothbard's book, America's Great Depression, was a big moment.
Rothbard argues that the Fed's policies in the 1920s actually caused the Great Depression. It challenged the whole idea that the Fed was needed to stabilize the economy. Paul was really convinced by this argument, and it became central to his own critique.
And this all ties into his disillusionment with Alan Greenspan, who went from supporting the gold standard to being the Fed chairman who oversaw some pretty major economic bubbles.
Right. Paul saw that shift as a betrayal of sound money principles. He felt Greenspan's embrace of easy money policies abandoning the gold standard was repeating the mistakes Austrian economists have been warning about for decades.
So we've got personal experiences, intellectual influences, all forming the foundation for his argument against the Fed. But what about the historical case? He goes all the way back to the Founding Fathers, doesn't he?
He does. He argues that they were very wary of central banking. They saw the problems caused by a mismanaged paper currency during the Revolutionary War. They wanted a system based on gold and silver for stability and reliability.
So he paints this picture of early America with a real deep distrust of central banking power. But if that was the case, how did the Federal Reserve even come to exist in the first place?
Well, Paul argues that it was political maneuvering and the influence of powerful banking interests. He points to the banking panic of 1907 as a key event.
Was it really as bad as they made it out to be, though?
Paul claims it was exaggerated, maybe even orchestrated to drum up support for a central bank. He talks about this secret meeting on Jekyll Island in 1910, where these leading bankers and politicians designed the whole Federal Reserve System.
Like a conspiracy to create the Fed.
He doesn't use that word exactly, but he definitely implies that there were ulterior motives beyond just economic stability. He believes it was more about consolidating power within the banking system, making sure those big banks always had a safety net.
Interesting. It sounds like the Fed was kind of born under a cloud of suspicion, promising stability but maybe serving other interests. What happens next in this historical overview?
That's where we get into the consequences of the Fed's actions in the 20th century, culminating in those financial crises that Ron Paul sees as, validating his fears. We'll explore all of that in the next part of our deep dive.
So we left off with the creation of the Fed and all these questions about its real purpose. Where does Ron Paul take us next?
Well, this is where he gets into the consequences of a fiat currency system. What the U.S. dollar became after we left the gold standard.
Yeah, and for people who might not know what that means, what is a fiat currency exactly?
Basically, it's money that isn't backed by a physical commodity, like gold or anything like that. Its value comes from government decree and market forces.
And Paul sees this as a huge problem, right?
Oh, yeah. He argues that taking the dollar off gold gave the Fed this almost unlimited power to create money.
Mm.
And he thinks that's led to all these boom and bust cycles, fueled by easy credit and artificial inflation.
One of the first examples he gives is the stagflation of the 1970s. Now, for those who don't remember that whole era, what exactly is stagflation?
It's like a really bad combination of high inflation and economic stagnation. It kind of goes against the usual economic theory.
How so?
Well, you'd normally expect inflation to happen when the economy is growing, but in the 70s, prices were going up like crazy, while the economy was sluggish and unemployment was high.
So how does Paul tie this back to the Fed?
He argues that the Fed's policies, especially expanding the money supply, were a major driver of that inflation. And those pressures, combined with things like rising oil prices, basically created the perfect storm for stagflation.
Then he moves on to the savings and loan crisis of the 80s. Another example of that boom and bust cycle, right?
Yeah, exactly. Paul argues that the Fed's low interest rate policies contributed to this speculative bubble in the savings and loan industry. They were making all these risky loans, and a lot of them went bad when interest rates finally went up.
And this was when Alan Greenspan came in as Fed chairman.
Right.
Wasn't he supposed to be this, economic genius, the maestro who could keep everything running smoothly?
He was seen that way. But Paul's really critical of Greenspan. He says that while his policies seem to work in the short term, they actually set the stage for even bigger crises down the road.
Like the dot-com bubble in the late 90s and then the housing bubble in the early 2000s.
Exactly. Paul says those low interest rates and easy money from Greenspan encouraged tons of speculation. Investors were taking on way more risk, pushing asset prices up to these unsustainable levels.
And when those bubbles burst, man, the consequences were brutal. The dot-com crash wiped out trillions of dollars, and then the housing crisis led to the 2008 financial meltdown.
And for Ron Paul, the 2008 crisis was like the ultimate proof he needed. It was the inevitable result of decades of irresponsible monetary policy, in his view, a clear sign of the dangers of a fiat currency system controlled by a central bank.
So it's been a lot of economics up to this point. But Paul's critique goes beyond just the practical consequences. He also makes a moral argument against the Fed.
Yeah, he does. This is where you really hear the passion in his voice.
Yeah.
He believes the Fed is inherently immoral because it violates basic principles of fairness and sound money.
He even calls it a form of theft, right?
He does. He says that by creating money out of thin air, the Fed devalues the money everyone else has already earned and saved. That's like a hidden tax that eats away at your purchasing power. And it benefits those who get that new money first, usually banks and big corporations.
He also says it undermines the rule of law and contracts because inflation makes it hard to plan for the future or to honor agreements you made in the past.
That's right. Paul thinks the Fed's actions erode trust in the whole financial system. It creates this uncertainty where it's really tough to make good economic decisions.
And then he takes this moral argument and connects it to a constitutional one.
Yes, Paul is a very strict constitutionalist. He says the Fed itself is unconstitutional. He points out that the Constitution gives Congress the power to coin money and regulate the value thereof, not to hand that power over to a central bank.
So he sees the Fed as this massive overreach of government power.
Absolutely, violating the Founding Fathers' vision of limited government and individual liberty.
So given everything we've talked about, his solution is pretty simple, isn't it? And the Fed?
Well, it sounds simple, but the big question is what happens next? What does a world without the Fed actually look like? That's where we start getting into the most controversial parts of his argument. And we'll dig into all of that in the final part of our deep dive. All right, so we've covered a ton of ground here. Ron Paul's personal journey, the historical context, all the economic arguments, the moral and constitutional objections to the Fed. It's a pretty radical critique of a system I think most people don't even think twice about.
It is radical.
Yep.
It really challenges the way we think about money and the role of government. Even if you don't agree with everything he says, Paul brings up some really important questions that we should all be thinking about.
For sure. But let's get to that big question. What's the alternative? What happens if we actually end the Fed like he wants us to?
Well, his vision is a world where money and banking are run by free market principles, not by some central authority like the Fed. He believes competition would actually lead to a more stable and sound monetary system. So instead of one central bank controlling everything, we'd have all these different currencies competing with each other.
Exactly. Paul's a big advocate for a free market in money.
Yeah.
Where people could choose to use gold, silver, digital currencies, whatever they trust and find convenient.
That sounds kind of chaotic, though. Wouldn't that just create a bunch of instability and confusion?
I know it sounds that way.
Uh,
That's a common concern, and Paul addresses it directly in the book. He argues that the free market is much better at regulating itself than people think. Competition would force banks and other financial institutions to be more responsible and transparent.
he uses that grocery store example, right? If you've got a bunch of grocery stores competing, they have to offer good products at fair prices or they go out of business.
Right. It's the same idea with money and banking.
Hmm.
If people can choose their currency, they're going to go with the ones that are stable, reliable, easy to use.
Mm.
And banks that are doing shady stuff or taking too many risks, they'd get punished by the market.
But wouldn't that mean a lot of banks would fail? Wouldn't that be even worse for the economy?
Well, Paul actually thinks allowing banks to fail is a necessary part of a healthy market. He says when you bail out banks that make bad decisions, it creates moral hazard. It encourages them to keep taking bigger and bigger risks because they know the government will always come and save them.
So basically let the market work it out, even if there are some rough patches along the way.
That's the idea. He believes the long-term benefits of a truly free market in money and banking are worth the short-term pain.
It's definitely something to think about, even if you don't totally buy into ending the Fed. It makes you question the way things work right now and if there could be a better way.
And that's the real strength of this book, I think. Whether you agree with Ron Paul completely or not, it challenges you to think differently about the financial system and be more critical of, the forces that are shaping our economy.
Well, it's been an interesting journey exploring this really complex and controversial topic. We hope you found this deep dive insightful and, something to really make you think. And
Yeah.
hey, keep those requests for deep dives coming. We love digging into the stuff with you guys.